Okay, let's unpack this. Have you ever wondered what truly makes a company financially robust? Or, why even the sharpest analysts sometimes send mixed signals?
Definitely. It's not always straightforward.
Well, today we're doing a deep dive into Copart Inc., ticker CPRT. They're a real powerhouse in the online vehicle auction space.
Right. A major player.
We've got this comprehensive report here. It covers financials, analyst views, market sentiment. It's dated June 25, 2025. Our mission, really boil it down for you.
Yeah. Give you the key takeaways.
Exactly. A shortcut, sort of, to being genuinely well-informed about Copart.
And this report, it gives us a really clear framework for looking at a company's health. We'll be digging into their growth, their profitability, financial strength, and importantly, how the market and the analysts are actually seeing them right now.
Okay.
What's fascinating, I think, is how all these pieces, they don't just sit there separately. They fit together, tell a story about where the company is and maybe where it's heading.
Right. And here's the big takeaway up front, kind of the headline from the report. Fundamentally, Copart gets rated as good company.
Good, okay.
Yeah, scoring of a very strong 4 out of 5 stars for its core fundamentals.
4 out of 5, that's solid.
So what makes Copart fundamentally good? The report really points to two key areas where they really shine.
Okay, what are those?
Their financial strength, which is described as rock solid, and their profitability, which is consistently excellent.
Financial strength and profitability, got it.
So first, let's talk financial strength. I mean, the report gives Copart a perfect score here, 5 out of 5 stars.
Oh, 5 out of 5.
Yeah, and it calls their balance sheet fortress-like. So what does a fortress-like balance sheet actually look like, in practice for Copart?
Right, fortress-like. It's a strong term.
Yeah.
What it means here is, well, exceptionally strong liquidity. They have cash,
Okay.
very little debt, practically minimal debt, and they generate really robust free cash flow. Like, for instance, their average current ratio over the last 5 fiscal years, FY 2020 to 24, it was 2.78. It's impressive.
Yeah.
Shows strong short-term liquidity.
0.78, okay.
And their quick ratio is also excellent, 2.68 on average, meaning, they can cover their immediate bills even without selling any inventory.
That's strong.
But maybe the most striking thing, the detail that really hammers home that fortresses idea, is their debt.
Yeah. Tell me about the debt.
Their debt-to-equity ratio averaged, get this, 0.01 over the last 5 years.
0.01. Seriously.
Seriously, it means for every dollar of equity, they have basically a penny of debt. Very, very little reliance on borrowing.
Okay.
And similarly, their debt-to-EBITDA ratio, that averages just 0.03. They generate so much cash flow relative to this tiny debt level.
Right.
Their FCF to total debt ratio averages an amazing 13.0.
That's remarkable. So basically no debt, tons of cash flow. It sounds like, as the report says, they have incredible operational flexibility and resilience too.
Exactly. They can weather storms, seize opportunities.
But does having so little debt, does that maybe imply a missed opportunity? Could they leverage up a bit, maybe for growth or acquisitions? Does the report touch on that?
That's a really sharp question. The report seems to imply this very conservative stance is actually a deliberate strength.
Yeah.
It gives them that huge resilience.
Okay.
It positions them, potentially, to buy distressed assets cheap if competitors loaded with debt start to struggle.
Yeah.
They just don't need outside money for day-to-day or even big moves. It de-risks the business fundamentally.
That makes sense. A strategic choice then. Okay, so foundation, rock solid, but you need strong performance on top of that, right?
Absolutely.
Let's turn to profitability, another near-perfect score here. 4.65 out of 5 stars, rated excellent. What's driving that?
Well, their profit margins are, frankly, exceptional for this industry. Gross profit margin, consistently above 44%. It averaged 46.27% over the last 5 years.
46% gross margin, wow.
Yeah. Operating profit margin averages 38.77%, and net profit margin averages 33.55%. These are just very, very strong numbers. Shows great efficiency, great bottom line profit.
Okay, impressive margins.
But there is a nuance worth noting. There's been a slight moderation in their return metrics, things like ROE, ROA, ROIC, in the most recent fiscal year, FY 2024.
A moderation? How slight?
Well, for example, return on equity, ROE, it dropped from about 25% back in FY 2020 down to 18.2% in FY 2024.
Okay, still strong, but definitely lower.
Exactly. Still strong overall, But the slight downtrend is, an interesting detail. It kind of suggests maybe their ability to generate returns from new investments might be maturing a bit.
Which isn't uncommon for successful, established companies.
Understood on the margins. Highly efficient. But this dip in returns, even if it's slight, for a company rated good, it raises a question. Does the report suggest if this is like a temporary thing, or maybe a trend to watch as they mature?
The report seems to lean towards it being, well, a natural part of their maturation. It's not presented as a red flag.
More like a recalibration. As a company gets really big, it just gets harder to generate the same percentage returns on an ever-growing capital base.
Right, the law of large numbers.
Exactly. So it's less about a problem, more maybe about a different phase of growth.
Okay, that makes sense. So stellar financial health, excellent profitability. The next obvious question is growth. Are they growing? And this is where the picture starts to shift a bit for Copart. The overall weighted growth rating is 3 out of 5 stars, 3.1. So tell us about this shift.
Exactly. So historically, looking back 5 years, FY 2020 to FY 2024, Copart showed really strong growth.
Yeah, you mentioned that earlier.
Revenue averaged 17.62% year-over-year growth. Net income and EPS, earnings per share, both grew over 21% a year. That's definitely high growth territory.
For sure.
But looking ahead, the forecast for FY 2025 through 27, key metrics like revenue, EBIT, FCF, they're all expected to moderate to around 10.3% year-over-year growth.
So down from 17-21% to around 10%, still decent growth, but a clear slowdown.
Right. And this isn't just, numbers changing. It signals a pretty critical transition for the company, moving from that kind of rocket ship growth to a more stable, maybe more predictable 10% growth. And that actually appeals to a different kind of investor, doesn't it?
Yeah, it does. Someone looking for more consistency, maybe less volatility than you get with hypergrowth.
Precisely. Predictable earnings become more valuable.
So still healthy growth,
Yeah.
but not the hyperdrive it once was. A significant evolution. Now, here's where it gets really interesting for me. How does this changing picture, this maturing growth, affect how analysts and the broader market see Copart now?
Yeah, that's the key question.
Let's start with the analysts. The sentiment there is described as mixed, 3 out of 5 stars. What's behind that mixed view?
Well, it's kind of a split story. On one hand, you have the average brokerage recommendation, the ABR. It's a solid buy at 2.0.
Okay.
That's based on 8 analysts, and 4 of them actually rate it strong buy. Let's look at the price target. The consensus target is around $63.33.
And the stock's around $48 now.
Right. So that implies, what, about a 32% upside? That's a pretty strong vote of confidence in a long-term value.
32% upside is significant, yeah.
But what tempers that, what brings in the mixed feeling, is the recent activity around earnings estimates.
Ah, okay. What's happening there?
The consensus EPS estimate for fiscal 25, it's actually decreased by 1.27% over the last month.
Decreased.
Yeah, and there were 3 downward revisions from analysts and 0 upward revisions in that time. Revenue estimates also show a bit of a negative trend recently.
Okay, so estimates are being trimmed slightly.
And their track record on actually hitting those estimates, their earnings surprise history, it's also a bit mixed. Over the last 4 quarters, 1 beat, 2 times they were in line, and 1 miss on EPS. Revenue surprises have been a bit better, more consistently positive.
Interesting.
It really feels like analysts are saying, look, we love the company long-term, great business, great balance sheet, but the next few quarters, the near-term path seems a little less certain.
Got it. So they see that long-term value, that potential upside, but the near-term forecasts, a bit shaky, showing some caution. Makes sense.
Exactly.
Now, beyond the professional analysts, what about the broader market? New sentiment, general investor buzz, that also comes in at 3 out of 5 stars, neutral to slightly positive. What's the pulse out there?
Well, the news flow itself is pretty neutral, just routine stuff mostly. Changes in who owns the stock, institutional holdings, analyst rating changes. We've seen some downgrades recently, but nothing huge, no major positive or negative news catalysts really grabbing headlines.
Okay, pretty quiet on the news front.
Yeah. And if you look at, say, social media, investment forums, that kind of thing, general sentiment seems stable. But there's definitely a debate happening.
A debate. Between who?
Between the long-term bulls people who rightly point to Copart's clear market leadership, the strong fundamentals we talked about.
Right, the fortress balance sheet, the profits.
Exactly. And then the bears who are focusing on that moderating growth picture and the fact the stock price hasn't done much recently, it's kind of underperformed.
So a classic growth versus value, or maybe growth versus maturing growth debate.
Kind of, yeah. And from a more technical trader perspective, Short interest is pretty low, about 2% of the float, so not many people are actively betting against the stock falling.
Okay, no big short positions building up.
Right. And activity in the options market, it doesn't really show extreme bullish or bearish bets either. It suggests a lack of really strong conviction either way right now.
Okay.
The market seems to be in a bit of a wait-and-see mode.
Okay, so the market clearly acknowledges Copart's quality, its strong position, but it's waiting for clearer signals, maybe some catalysts, especially now that the growth engine isn't firing on all cylinders like it used to.
That sums it up pretty well. If you connect all these dots, the bigger picture is Copart is undeniably a high-quality company. Fantastic business model, incredibly strong financial foundation. That profitability, that balance sheet, those are huge strengths, real differentiators. But that moderation in growth, it's clearly influencing how analysts and the market are valuing it right now. Hence the mixed sentiment.
Right. So wrapping this up, what does this all mean for you, our listener? This deep dive, it really shows a company transitioning, doesn't it?
Definitely transition.
Moving from that hyper-growth phase, but, and this is key, doing it from a position of immense financial strength, almost unparalleled strength. The report concludes it's a compelling name, but specifically for investors with a genuinely long-term perspective.
Yeah, patience seems key here.
Which brings us to a final thought, maybe something for you to mull over. In a market world that often seems obsessed with constant high growth, how do you personally value a company like this? One that shifts from that really exciting, rapid hypergrowth to a phase that's more mature, more stable, but still exceptionally profitable. Is that predictable profitability just as valuable in your eyes as explosive growth? Or does that kind of transition change your whole investment thesis?
It's a great question to consider.
Something to think about. Thank you for joining us for this deep dive into Copart. Until next time, keep exploring, keep questioning, and keep getting well informed.